Welcome to Elliott Wave International's e-learning series for traders. This course is entitled The Basics of the Wave Principle. My name is Wayne Gorman, and I will be your instructor throughout this course. I'll first talk about Ralph Nelson Elliott and his discovery, the wave principle. I'll then cover motive waves, corrective waves, rules, guidelines, wave personalities, Fibonacci relationships, and then we'll have a summary at the end of the key points of the course. These sections are all numbered to make it easy for you to navigate from one section to the next. You also have a control bar at the bottom left corner that makes it easy to navigate within sections. So let's start with the introduction. Our research shows that in financial markets, investors have an unconscious impulse to herd. That is, they follow the actions of others, whether those others are on the right side of the market or not. They make subjective, impulsive decisions under conditions of uncertainty, and the resulting prices or values do not revert to a particular mean or equilibrium. The prices are in fact following a pattern. The wave principle states that financial markets are pattern, and it is that pattern that we are going to analyze in this course. But before we get into the pattern, I'd like to just talk a little bit about the person who discovered the wave principle, Ralph Nelson Elliott. Ralph Nelson Elliott, an accountant by trade, analyzed the stock market in the early 1930s. He discovered that crowd behavior moves up and down in certain recognizable patterns that he referred to as waves. These wave structures link together to form larger versions of the same patterns, and in turn become the building blocks for patterns of next larger sizes, and so on. He coined this phenomenon the wave principle. And in his book, Nature's Law, The Secret of the Universe, he explained his observations. So let's look at the basic pattern of Elliott's discovery of the wave principle. It consists of a structure, as you see here, of 5 waves up, numbered 1 through 5. And the way to look at this chart is to imagine time going horizontally on the x-axis and price on the y-axis. So these lines are actually representing prices, or a plot of price points over time in a financial market. And the time frame could be a day, a year, a week. In either case, the structure is similar, and we're going to get into that in a few minutes. After a 5-wave sequence has been completed, there is a corrective phase, and we use letters A, B, and C to label the 3 waves of the correction. If you look on the left side of this diagram, you'll see that I've labeled the first 5-wave advance the motive phase. The motive phase consists of 5 waves up going in the direction of the main trend. Waves 1, 3, and 5 are called actionary waves. They're moving in the direction of the main trend of one larger degree, and I'll explain that term degree on the next slide. Waves 2 and 4 are called corrective waves. They interrupt the main trend. Each of these waves can further subdivide into other waves. And let me show you what I mean by that. On this diagram, I've divided each of the actionary waves 1, 3, and 5 further down into 5 waves, and waves 2 and 4 into 3 waves. I've also subdivided waves A, B, and C into further wave structures. So, for example, this whole time period might be 1 year, but the other wave structures within each wave may be several weeks or several days. We refer to each of the time frames as degrees. And if I carry it a step further, You can see I now have also subdivided further each of the waves into their components. Waves 1, 3, and 5 further subdivide into 5 waves, waves 2 and 4 into 3 waves. In order to communicate our analysis, we assign labels to these various time frames or degrees. Here's a chart that shows the different types of degrees. The highlighted area indicates various degrees or time frames that we're analyzing markets most of the time: cycle, primary, intermediate, minor, and minute. Here's a more realistic diagram of what the stock market would look like, showing the wave structure. We have 5 waves up, waves 1, 2, 3, 4, and 5. And each of the actionary waves, waves 1, 3, and 5, further subdivide into 5 waves. And each of the actionary waves within that structure also subdivide into 5. Waves 2 and 4 subdivide into 3. We refer to this characteristic of similar structure at different time frames as self-similarity. That is, the structures are similar but not exact at each time frame. And we have a name to characterize that feature. We call that a robust fractal. A robust fractal is any structure that is similar at different time frames but not exact. Let me show you a real example of that on the next slide. This is the Dow Jones Industrial Average at various time frames, starting with chart 1. It's a second by second chart of the Dow, and then going across to chart 2, which is hourly, and then daily, weekly, monthly, and yearly. We also see the wave labels on each chart, labeling the motive phase going up in waves 1 through 5 and the corrective phase labeled A, B, and C. Notice how in charts 1 through 5, although they are vastly different time frames, the structures are similar: 5 waves up, 3 waves down. In chart number 6, the structure is 5 waves up and is similar to the first phase of charts 1 through 5, but since it has not completed its cycle, you don't see the ABC corrective phase. If I carry it a step further, with chart number 7, comparing to charts 5 and 6, chart number 7 is a decade-by-decade chart of the stock market, and you can see it has a similar structure of 5 waves up, similar to chart 6 and the first phase of chart 5. Therefore, we say that the stock market and other financial markets are robust fractals. They are similar in structure at each time frame, or what we call degree. The wave principle states that mankind's progress, usually measured by the stock market valuation, is not a straight line, random, or cyclical. It is patterned. Growth and thereby social systems are moving in a pattern consisting of 5 waves up and 3 waves down. This pattern reflects the alternation of growth and non-growth or decline. Why is the wave principle so important? 3 key reasons. First, it helps us to predict market direction. Second, we can identify turning points in markets. And lastly, it provides guidance for entering and exiting positions, whether they be trading positions or investment positions. We are now going to cover the section on motive waves. And I want to start out by going back to the basic chart. And as you can see on the left side, we have the motive phase, which are the 5 waves up that are numbered. That's the area we're going to focus on in this section. Here are the key characteristics of motive waves. They are 5-wave structures numbered 1 through 5. They're moving in the direction of the main trend of one larger degree. Wave 2 cannot retrace more than 100% of wave 1. Wave 3 can never be the shortest and is often the longest. Motive waves can be divided into two types of structures: impulse waves and diagonal triangles. Impulse waves can be further subdivided into extensions and truncations. Let's first talk about impulse waves. The key characteristics of an impulse wave is first that wave 4 never enters the price territory of wave 1. The actionary waves 1, 3, and 5 are motive waves themselves. And wave 3 is always an impulse wave. Let's look at some diagrams and demonstrate these rules for impulse waves. On the far left, you see a diagram waves 1, 2, 3, and 4. That is an incorrect wave count. Why do you think that that would be incorrect? It's because wave 4 overlaps the price territory of wave 1. In the middle diagram, we have another example of incorrect counting. Can you detect where the error is in this wave count? It's right in here, wave 3. Wave 3 cannot be the shortest, so that wave count is incorrect. On the far right, we have the correct wave count for the middle diagram, which is intermediate waves 1 and 2. Intermediate, remember, that's a label we use to designate a certain degree, which then wave 3 is unfolding, and wave 3 is made up of waves 1, 2, and 3, but in the diagram we don't see any further price action. So that's the correct way to count in that particular example in that diagram. Let's look at a real-life example of counting impulse waves. This is the S&P 500 stock index. It's the cash index, a daily bar chart from August 2004 to March 2005. I want you to look at this chart just for a few seconds and see how you would label the wave count on this chart. Okay, let's go to the next slide. And you can see here are the wave labels. This is an impulse wave, and I've labeled it waves 1, 2, 3, 4, and 5. Notice wave 4 does not enter the price territory of wave 1. Wave 3 is not only not the shortest wave, it happens to be, in this case, the longest wave. But there's another thing I want to point out. Notice where I said wave 1 ended. The actionary waves within an impulse wave must also subdivide into 5 waves. So we cannot say that wave 1 ended over here. Wave 1 ended over here where I first labeled it, and wave 2 is a corrective wave made up of 3 waves. We call wave 2 an expanded flat, and we'll get into that in the third section on corrective waves. Here's another example of an impulse wave, waves 1, 2, 3, 4, and 5. Impulse waves can be seen in all types of markets. In this case, this is a chart of real estate loans as a percentage of total commercial loans and leases at U.S. banks as monthly data from 1947 to 2004. And as you can see, we do have an impulse wave to the upside. Wave 4 does not overlap the price territory of wave 1. Wave 3 is not the shortest. Wave 2 does not retrace more than 100% of wave 1. Here's an example of an impulse wave in a downtrend in gold. This is April gold futures. It's a daily bar chart. And you see we have the 5-wave decline, waves 1, 2, 3, 4, and 5, completing an intermediate wave 1. Now let me step back a bit and talk about, well, what is the significance of knowing this? Or one very important aspect is that once a 5-wave sequence has been complete, we know that there'll be the corrective phase. In other words, there'll be a change in trend, a change in direction. So if we can identify a 5-wave decline or a 5-wave advance, that will give us a signal to prepare for a counter trend move. As you see here in this diagram, after wave 1 in parenthesis was complete, we had an ABC zigzag wave 2 to the upside, correcting this impulse wave. Within impulse waves, we can have what we call extensions. Extensions are an elongated impulse wave. They can appear in either waves 1, 3, or 5. They're often seen in wave 3 for the stock market, and they're often seen in wave 5 in commodity markets. And here's a diagram of what we mean by extensions. In the top example, we have an extension that occurs in wave 1, when we see it in a bull market and a bear market. In the next diagram below that, we see an example of a 3rd wave extension, a 5th wave extension below that, and then in the last diagram, we see that it's not clear which of the waves 1, 3, 5 is the extended wave. But we do see a total of 9 waves. And therefore, that number 9 still signifies that we have an impulse wave, because if you have waves 1, 2, 3, 4, and 5, and one of the waves is extended, regardless of which wave is extended, the total number of waves will be 9, and that tells you it's an impulse wave. We can also have extensions within extensions. So, for example, on the left side, you see a diagram of a 3rd wave extension of a 3rd wave extension. Here is the 3rd wave that's extended, and then within that 3rd wave, here is the wave 3 that is also extended within the extension. On the right side, we see an example of a 5th wave extension of a 5th wave extension. So here we have wave 5, here's the extended wave, and within wave 5 we have a 5th wave extension within the extension. I want you to look at this chart and see if you can find the extension. Think about how you would label this chart, how you would count the waves on this chart. This is the Dow Jones Industrial Average, monthly data on a log scale from the mid-1970s through 2003. I'll just take a few seconds. Here's the proper labeling for this chart. We have waves 1, 2, 3, 4, and 5. Wave 5 was extended. And you can see here the subdivisions within wave 5 circled. We have subdivisions in parenthesis, waves 1, 2, 3, 4, and 5. And you can also see that within that, wave 3 itself was also extended. Why is this piece of knowledge important? If you're trading and you want to hold on to a position that's going in the right direction for as long as possible, you need to be aware of extensions. You certainly would not want to miss an extension, assuming you're on the correct side of that move, so it's important to be aware of them and identify them. It can be quite lucrative for your trading and investing. Here's an example of a third wave extension. This is the US dollar index. It's weekly data on a log scale from 2001 to 2005, and you can see waves 1, 2, 3, 4, and 5. Wave 3 is extended, and you can see the subdivisions within wave 3, waves 1, 2, 3, 4, and 5. I now want to talk about truncations. A truncation in an impulse wave is where wave 5 does not exceed the end of wave 3. A truncated wave still contains the necessary 5 subwaves, and they often occur after a strong third wave. Here's a diagram showing a truncated fifth wave in a bull market and in a bear market. And as you can see, the fifth wave does not terminate beyond the termination point of wave 3, as I'm showing here in the bull market truncation. And in the bear market truncation, you can see that wave 5 does not go beyond the termination of wave 3, yet it still has the necessary 5 waves within that wave 5, or within the truncated wave 5. Here's a real-life example of a truncated fifth wave. This is the Swiss stock market index from the late 1980s up until in the early 2000s. And you see here wave 3 terminates. We have a wave 4 that I'm highlighting here. And wave 5 does not end beyond wave 3. It was truncated. And then you have the corrective structure that occurs after wave 5. This is a close-up version, and you can see that wave 5 has the necessary subdivisions 1, 2, 3, 4, and 5, but wave 5 does not go beyond the termination of wave 3. Truncated fifth waves are difficult to pick up in real time, but you should still be aware of them, so when they do occur, you can adjust your wave count accordingly. Let's now talk about the second type of motive wave. Remember I said there were basically 2 types, impulse waves and diagonal triangles. We just finished talking about impulse waves, and now we're going to talk about diagonal triangles. Here are the key characteristics. In a diagonal triangle, wave 4 almost always moves into the price territory of wave 1. So it's a big difference from the impulse wave. You do have that overlap. Waves 1, 3, and 5 are composed of 3 subwaves, not 5. A diagonal triangle is found at termination points of a larger pattern, so they indicate the exhaustion of that larger pattern. And finally, they normally have a wedge shape bounded within 2 converging lines. So here are diagrams of diagonal triangles. On the left side, in a bull market, 5 waves to the upside. On the right side, in a bear market. And the fifth wave that I'm highlighting in here, that's the diagonal triangle. Notice it has 5 waves, but each wave is made up of 3. Each of the actionary waves is made up of 3, as well as the corrective waves 2 and 4 are made up of 3. And you see that it converges within these two trend lines, one that has connected the termination points of waves 1 and 3, and the other that's connected the termination points of waves 2 and 4. This is called a contracting diagonal triangle. And the key importance of a diagonal triangle is that once the triangle has ended, the diagonal triangle has ended, it is followed by a swift move that retraces the entire diagonal and possibly more. Another aspect of these diagonal triangles is that wave 5 will often terminate just slightly above that trend line that connects the termination points of waves 1 and 3. We call that a throwover. It gives us another signal that the diagonal triangle is ending and that you're going to have a swift move in the opposite direction that retraces the entire diagonal. So let's look at some examples of diagonal triangles. This is an old chart published by Elliott Wave International back in 1993. It's U.S. bond futures. It's an hourly chart. And you can see here the diagonal triangle, waves 1, 2, 3, 4, and 5. And you see the subdivisions within each of the wave structures. Waves 1, 3, and 5 are subdividing into three waves. Wave 1, ABC, three-wave structure. Wave 3 is also made up of an ABC three-wave structure. And wave 5, another ABC three-wave structure. And waves 2 and 4 are also three-wave structures. Notice that wave 5 terminates slightly beyond the trend line, the upper trend line, and then you see the swift move to the downside as it retraces the entire diagonal triangle. This is feeder cattle futures. And this is an example of an expanding diagonal triangle. You see that the trend lines diverge, but we still have the similar structure, waves 1, 2, 3, 4, and 5. And all of the waves are made up of three subdivisions. You see the swift move to the downside that retraced the entire diagonal and actually went a bit further. This is a chart of cocoa futures, weekly continuation chart from 1997 to 2001. And again, I want to further illustrate the power of identifying this particular structure. You see, in this case, we have a downtrend, waves 1, 2, 3, 4, and 5. Wave 5 is a diagonal triangle. It's made up of waves 1, 2, 3, 4, and 5. You see I've connected the termination points of waves 1 and 3 and waves 2 and 4, and you have the converging trend lines. Let's blow that up and take a closer look at it. Here's a larger version, and in the inset on the left side, you see in a diagram form what we're expecting after this diagonal triangle fifth wave ends. Notice how waves 1, 2, 3, 4, and 5 are all made up of three-wave structures. Wave 5 has gone below the lower trend line. We call that a throw under, and that gives a strong signal that the diagonal triangle is ended. And when the diagonal triangle is ended, we have a swift move in the opposite direction, retracing the entire diagonal and possibly more. And if I go to the next slide, you now see what happened. We had that sharp move to the upside, which did in fact retrace the entire diagonal triangle. And if I go back to the larger picture, now you see the entire sequence, the 5 waves down, ending in a diagonal triangle, giving us that signal of a swift move, counter-trend move to the upside. Let's summarize now what we've covered in the section on motive waves. But I first want to remind you, and I have this up at the top, keep in mind the wave principle is really a graphic of mass psychology. We're talking about crowd behavior, unconscious herding behavior. Okay, motive waves. They're 5-wave structures moving in the main trend of one larger degree. There are 2 types of motive waves, impulse and diagonal triangle. In the impulse waves, waves 1, 3, and 5, the actionary waves, also subdivide into 5 waves. We can have extensions within impulse waves and truncations. Wave 4 does not enter the price territory of wave 1. With diagonal triangles, waves 1, 3, and 5 subdivide into 3 waves. And wave 4 does enter the price territory of wave 1, so you do have that overlap. And a diagonal triangle gives a strong signal of an imminent major trend reversal, a swift move in the opposite direction that retraces the entire diagonal triangle and possibly more. And that concludes our section on motive waves. This section is on corrective waves. These are wave structures that fall in the category of the corrective phase, which you see here on this chart in the upper right-hand corner. We label these waves using letters. There are 4 different types of corrective structures. The first is called the zigzag, which you see on this chart in front of you. The zigzag is made up of 3 waves, A, B, and C. Wave A subdivides into 5 waves, wave B subdivides into 3 waves, and wave C subdivides into 5 waves. So we'll sometimes refer to this as a 5-3-5 structure. The zigzag has a sharp look to it, normally occurs in second waves of an impulse wave, and it normally makes a deep retracement. This is a chart of coffee futures. It's a daily chart in 2005, and you see in the middle of the screen in the chart the zigzag correction for wave 4. The A wave is made up of 5 waves, the B is made up of 3 waves, and the C wave is made up of 5 waves to the downside. The next structure we're going to talk about is called the flat. A flat has 3 waves, A, B, and C. Wave A subdivides into 3 waves, not 5. Wave B subdivides into 3 waves, and wave C subdivides into 5 waves. With the flat structure, wave B terminates in the area of the origin or the originating point of wave A. Wave C terminates near the termination point of wave A. There are 2 types of flats. We have the regular flat, which you see in front of you. The other type is called the expanded flat, and sometimes you may also hear the term irregular flat, which means expanded flat. And with the expanded flat, wave B will terminate well beyond the origin of wave A, and at the same time wave C will terminate beyond the termination point of wave A. Let's look at some examples of a regular flat and expanded flat. You see on this chart, this is soybean oil futures in 2005. And in the upper left side of the chart, you see an example of a flat structure, a 3-wave A followed by a 3-wave B structure that retraces most of the A wave, and then a C wave that goes back to the termination point of wave A. On the lower part of the chart, you see an example of an expanded flat. It's still a 3-3-5 structure, But in this case, wave B has terminated well beyond the origin of wave A, making a new price extreme to the downside, followed by a 5-wave C wave that has gone beyond the termination point of wave A. These structures are important in trading because they often fool traders, especially with the expanded flat. Look what happened down here. With the expanded flat, the B wave made a new price low, which may have caused some traders to think that the downtrend would continue from there, especially traders who follow certain trend following systems. But look what happened. The trend reversed and you had that big C wave to the upside. So it's important to be able to identify these types of flat structures so that if a new price extreme occurs, you don't feel like, well, that's the continuation of the preceding trend. The next structure that you see in front of you is called the triangle. The triangle is made up of waves A, B, C, D, and E. Each of these waves subdivide into 3 waves. The triangle is bounded by what we call trend lines that connect the termination points of waves A and C and the termination points of waves B and D. In this case, in this particular type of triangle, we call these converging trend lines. And as you can see, the triangle in this particular case is contracting. Wave E of the triangle may either overshoot or undershoot its AC trend line. This is a very valuable structure to be able to identify, because when the triangle ends with the termination of wave E, it is followed by a thrust out of the triangle in the next actionary wave of one higher degree. So the triangle gives you a strong signal that this corrective structure, when it does end, will have another actionary wave moving in the direction of the main trend. There are different types of triangles. These are all called horizontal triangles, and this was Elliott's original list of the various types of triangles. So let's go through them, starting with the ones at the top. The first section, and we see examples of bull market and bear market. The first section is called symmetrical triangles. That's where the trend lines are contracting, both the upper trend line and lower trend line are converging, and we have a sideways move. The next type is called the descending trend line, where the AC trend line in the bull market is horizontal and the BD trend line is pointing down. In the case of a bear market, the BD trend line is horizontal and the AC trend line is pointing down. With the ascending triangle, it's the opposite. In a bull market, the BD trend line is horizontal and the AC trend line is pointing up. And in the bear market, the AC trend line is horizontal and the BD trend line is pointing up. In the last example, we have expanding triangles, where the trend lines are diverging rather than converging. Another important aspect of triangles is that triangles use up a lot of time. So you have to be patient when you're trading within triangles as all of these different wave structures unfold. Our research shows that we don't really see descending triangles in a bull market, and we don't see ascending triangles in a bear market. So we've recently now combined those two into one form, which we now call the barrier triangle. And that's in the middle section of this chart. We can combine the ascending and descending into one form. This is called the barrier triangle, and in a bull market with the barrier triangle, the BD trend line is horizontal and the AC trend line is pointing up. In a bear market, the BD trend line is horizontal and the AC trend line is pointing down. So we really can boil it down to 3 types of triangles: contracting, barrier, and expanding in terms of what we call horizontal triangles. We also have another type of triangle called the running triangle. The key characteristic of the running triangle is that the B wave goes well beyond the origin of wave A. And you see here some diagrams, one of a bull market and one of a bear market, of a running triangle. But you still have the overall same structure. Each wave subdivides into 3 waves. And the E wave can either overshoot or undershoot the AC trend line. This is a chart of the Dow Jones Utilities Index from 1980 up till 1995, and you see a triangle in the wave 4 position. Triangles often occur in wave 4, but they also can occur in other structures, which we will show in the next slides. You see it has a sideways look to it, and you see each of the waves within the triangle, waves A, B, C, D, and E. You see that wave E overshoots the AC trend line, signaling the end of the triangle, and then you see the thrust out of the triangle. We also have a guideline called post-triangle thrust measurement that gives you an estimate as to how far the next actionary wave will go after the triangle terminates. But we're going to talk about that in the section called guidelines. It's very important to keep in mind that the triangle always precedes the final actionary wave in the pattern of 1 larger degree. Here's an example of a triangle in wave 4. This is coffee futures May contract in 1999. This is an expanding triangle. It's an expanding triangle because the AC and BD trend lines are diverging. But other than that, the structure is the same. Each wave is made up of 3 waves. And then you have the final actionary wave, wave 5, in this impulse wave to the downside after you see the wave E that overshoots the AC trend line. Here's an example of a triangle within an ABC zigzag. Remember, we talked about zigzags at the beginning of this section. A zigzag is a 5-3-5 structure made up of waves A, B, and C. In this case, the triangle occurs within the B wave. And so you have waves A, B, C, D, and E. It's a contracting triangle. In this case, the E wave undershoots the AC trend line. And then you have the thrust downwards in wave C. Here's another example of a triangle within a B wave of an ABC zigzag, but in this case, it's an expanding triangle. This is coffee futures quarterly data from 1972 up till 2004. And you can see that after the expanding triangle is complete, the E wave, which doesn't quite touch the AC trend line, is followed by the next move out of the triangle, the C wave, to the downside. The last type of corrective structure that we want to talk about is called the combination. And as the word implies, the combination means that you have more than one corrective structure linked by another structure which we call the X wave. The X wave is a 3-wave structure that links 2 corrective structures, any 2 of a flat, a zigzag, or a triangle. We use letters W, Y, and Z to label each of these separate corrective structures within the combination. In this diagram, you see a flat correction, a ABC flat, which we label W, linked by an X wave, followed by a contracting symmetrical triangle for wave Y. Here's another example of a combination. We have a flat structure in ABC 335, which we label as W, linked by an X wave, followed by a zigzag, which we've labeled Y. We could also have another zigzag X wave, followed by another corrective structure, which we would label Z. Here's an example in coffee futures. This is monthly data from 1991 up until the early 2000s. And you see an ABC zigzag, which is then followed by an X wave that links it to another ABC zigzag. This is coffee futures, a weekly chart in the early 2000s. And again, we have an ABC corrective structure linked by an X wave followed by another ABC corrective structure. So it's important to be aware of combinations, because when a corrective structure terminates and you've been able to identify that, but you don't get the next actionary wave, you find yourself identifying more corrective structures, then most likely you are experiencing a combination of two or more corrective structures. Here's an example in cotton futures. This is July contract back in 2003-2004. And here you see three corrective structures, three zigzags, all linked by an X wave. So we would label these as W, Y, and Z. Let's summarize corrective waves. We talked about the zigzag. That's a 5-3-5 structure. The A wave subdivides into 5 waves. The B wave subdivides into 3 waves. And the C wave subdivides into 5 waves. The zigzag has a sharp look to it, and it normally occurs in wave 2. The flat is a 3-3-5 structure. Wave A subdivides into 3 waves. Wave B subdivides into 3 waves, and wave C subdivides into 5 waves. The shape of the flat is sideways, and it normally occurs in wave 4. We also have expanded flats, where the B wave goes beyond the origin of the A wave, and the C wave goes beyond the termination point of the A wave. Triangles are made up of waves A, B, C, D, and E, and each wave within the triangle subdivides into 3 waves. Triangles have a sideways shape. They use up a lot of time, and they often occur in wave 4. The combination structure is made up of any of the other 3 corrective structures, which are linked by an X wave. Combinations are sideways and often occur in wave 4. And that concludes our section on corrective waves. We're now going to talk about Elliott's rules. There are only 3 rules. The first is that of waves 1, 3, and 5, wave 3 can never be the shortest wave. The second rule is that wave 2 can never retrace more than 100% of wave 1. And the last rule is that the end of wave 4 can never overlap the orthodox end of wave 1. As a strong guideline, and we'll be getting into guidelines in the next section, but since this is a strong guideline, I include this in the rules section. No portion of wave 4 can enter the price territory of wave 1 or wave 2. Let's look at a diagram that illustrates these 3 rules. First, at the top, we see that wave 2 cannot retrace more than 100% of wave 1. If we look at wave 3, we see that wave 3 is never the shortest of waves 1, 3, and 5. And lastly, you see wave 4 does not overlap the price territory of wave 1. I want you to look at this diagram and see how you would label this wave structure. If we look at the 5-wave structure here, we could call this 1, 2, 3, 4, and 5. But then what wave is that? Can we say that this is wave 1 and that this is wave 2 up here, and that we're going to resume the downtrend and take out the low of wave 1? No, we cannot say that, because wave 2 cannot retrace more than 100% of wave 1. Therefore, we must label this 5-wave decline as a wave C of some correction that that preceded this, and that we have a move to the upside, a new trend to the upside. And I've indicated that here. The 5-wave move to the downside cannot be the start of a new trend, but it can be wave C of a corrective pattern. Look at this diagram. I want you to think about for a few seconds how you would label this wave structure. Well, we could call this a 1, 2, 3, maybe this is 4. Could also be an ABC correction, followed by a new trend to the downside. Let's add some more information. Now, how would you label this structure? Can it be 1, 2, 3, 4, 5? No, that is not correct. Wave 3 can never be the shortest wave of waves 1, 3, and 5. So the way we label this structure is we label 1, 2, and then this is 1, 2, 3 of 3. Therefore, wave 3 in this case, this wave 3, is possibly an extension. Now look at this diagram. How would you label this? Well, it could be an A, B, C, and maybe the downtrend will resume. Could also be a 1, 2, 3. 2 has not retraced more than 100% of 1. And notice in each of these diagrams, we indicate a significant bottom. Of course, if we were looking at downtrends, we would be talking about a significant top. But a question that often comes up is, where do you start counting? Markets are continuous. They don't really have a beginning and an end. Well, you always start from a significant bottom or top. Let's look at the next diagram. We have now carried the previous chart forward, and as you see here, we have a couple of choices on how we could label this. And I've put them on this slide. You see, we could have a 1, 2, 3, and that this section in here maybe is 2 of 3. Or it could be an ABC correction, and we're starting wave 1 to the downside. But the important point here is that wave 4 cannot overlap the price territory of wave 1. So this could be the start of a third wave extension, or it's an ABC correction. So let's summarize what we've covered in this section. Of waves 1, 3, and 5, wave 3 can never be the shortest. It doesn't have to be the longest, but it can never be the shortest. Wave 2 can never retrace more than 100% of wave 1. And wave 4 can never enter the price territory of wave 1. That concludes the section on Elliott's rules. This section is on guidelines. The guidelines that we're going to cover are as follows: equality, alternation, depth, channeling, throwover, volume, and post-triangle thrust measurement. Let's start with wave equality. By wave equality, we mean two of the motive waves in a 5-wave sequence will tend toward equality in time and magnitude. This is generally true of the two non-extended waves. For example, if wave 3 is extended, then waves 1 and 5 will tend toward equality. Here's an example. This is the Russell 2000 Stock Index daily data from July 2002 through the end of 2004. We have a 5-wave impulse wave to the upside, waves 1, 2, 3, 4, and 5. And as you can see, wave 3 is the extended wave. If we look at waves 1 and 5, we see that they are similar in length in terms of price distance and time. Here's an example in the US dollar index weekly data from 2001 to 2004. And again, in this situation, this is a downtrend, but wave 3 is extended. You see the subdivisions of wave 3, 1, 2, 3, 4, and 5. And then you can see that waves 1 and 5 are similar in length with respect to price and time. Let's now talk about the guideline of alternation. Within impulse waves, if wave 2 is a sharp correction, expect wave 4 to be a sideways correction, and vice versa. Sharp corrections never include a new price extreme. An example would be zigzags. Sideways corrections usually include a new price extreme. Examples would be flats, triangles, and combinations. Diagonal triangles do not display alternation in subwaves 2 and 4. Here's a diagram that illustrates the guideline of alternation. On the left, you see a bull market where if wave 2 is sharp, wave 4 is sideways, and when wave 2 is sideways, wave 4 is sharp. And in the bear market on the right, to the downside, wave 2 is sharp and wave 4 is sideways. And when wave 2 is sideways, wave 4 is sharp. Generally then, when we're referring to sharp and sideways, a sharp correction would be a zigzag. Sideways could be a flat, or expanded flat, or a triangle. Keep in mind also that a triangle will alternate with any other structure except another triangle. So in using the guideline of alternation, keep in mind that a triangle will alternate with a flat correction or a zigzag correction, just not another triangle. Here's an example of alternation in this impulse wave to the downside. This is coffee futures May contract. It's a daily chart from 1998 to 1999. And as you can see, wave 2 is sharp. It's a sharp pullback, does not make a new price extreme, whereas wave 4 is sideways and does make a new price extreme to the downside with waves B and D. Here's a chart of the euro. We see waves 1, 2, 3, 4, and 5. And you see in this impulse to the downside that wave 4 is a triangle alternating with this expanded flat correction in wave 2 over here. This is December 2003 cocoa futures. And we have a couple of examples of alternation here. First, let's focus in on the bigger picture. We have waves 1, 2, 3, 4, and 5. And if you notice, wave 2 is an expanded flat. It has a sideways shape wave B makes a new price extreme, and wave 4 is alternating with that. Wave 4 is a sharp zigzag to the downside. And we can also see the alternation in the subdivisions of this wave 3 here that I'm highlighting. We have waves 1, 2, 3, 4, and 5. Wave 2 is an expanded flat, makes a new price extreme. And wave 4 is a sharp zigzag to the downside. Another example in impulse waves. This is natural gas, daily continuation chart. And we have here waves 1, 2, 3, and 4. Wave 2, as you can see, is an expanded flat as sideways move. And wave 4 is making a sharp zigzag to the downside. If we look at the subdivisions of this wave 3, we also see alternation. If we look at waves 1, 2, 3, 4, and 5, we see wave 2 is an expanded flat, and wave 4 is a sharp zigzag to the downside. We also have the guideline of alternation with corrective waves in the following manner. If a correction begins with a flat ABC structure for wave A, then expect a zigzag ABC structure for wave B and vice versa. If a large correction begins with a simple ABC zigzag for wave A, wave B will stretch out into a more complex ABC zigzag. Here are some diagrams of what we mean by alternation within corrective waves. On the diagram on the left, you see a flat correction for wave A 3, 3, 5, and then you see a zigzag, a sharp zigzag for wave B. On the right side, you see that wave A is a sharp zigzag, a 5, 3, 5, and wave B has made a flat correction, a 3, 3, 5. Another example of alternation within corrective waves in these diagrams, we see wave A is a simple zigzag, whereas wave B is stretched out more over time in a 5, 3, 5 structure. And on the right diagram, we see wave A as a simple zigzag. We see wave B elongated in a 5, 3, 5 structure and an elongated C wave. Let's look at some examples. This is July 1984 cotton futures. And I want to focus in on this wave 4. You see that the A wave within this wave 4 is a flat correction. It's a 3, 3, 5. Wave B makes a new price extreme here. But the wave B is a zigzag. It's a sharp zigzag to the upside. And then we have the 5 waves down in wave C. In this example of alternation, this is July 1985 coffee futures. We have an ABC correction for wave 2. Wave A is a zigzag, a sharp ABC down. And as you can see, wave B is strung out over time as a complex correction. It's a flat ABC, where wave B goes slightly beyond the origin of this A wave, and wave C goes beyond the termination point of this A wave, forming a flat correction versus the simple zigzag correction of wave A. And then we have the C wave to the downside after the termination of the B wave. Another example of alternation in corrective structures, we see first the A wave. If we focus in on this wave 2, this A, B, and C, we see alternation. We see an A wave that's 5, 3, 5. It's a zigzag, followed by a flat correction in the B wave, which is a 3, 3, 5 correction. Notice how within this B wave, you also have alternation. The A wave is a flat, and this B wave is a zigzag. Let's talk about depth of corrective waves. Corrections, especially when they are fourth waves, tend to register their maximum retracement within the span of travel of the previous fourth wave of one lesser degree, and most commonly near its terminus. Well, what do we mean by that? Let's look at this diagram and focus in on this fourth wave. And notice in the diagram the fourth wave terminates right at the termination point of this fourth wave. And notice that this fourth wave in parenthesis terminates at the previous fourth wave, but at one lesser degree, which is this fourth wave right in here. But generally, the guideline is that wave 4 will terminate somewhere in the area of the fourth wave, which can be this entire area, but most commonly near its termination point. Here's an example. This is Japanese yen against the US dollar from 1999 to 2002. And we have waves 1, 2, 3, 4, and 5. And I want to focus in on this fourth wave in parentheses, intermediate wave 4. And notice it terminates in the area of the previous fourth wave of one lesser degree, which is right over here. All of these guidelines, as we go along, serve as important ways to identify entry and exit points and stop levels for your trading. So, for example, in this particular chart, if you're looking to go short, let's say at the top of wave 4, you have some confirmation not only from the subdivisions of wave C, which are 5 waves, but the fact that it has entered the territory of the previous fourth wave of one lesser degree and is actually quite close to the termination point of the previous fourth wave of one lesser degree. Here's an example in the euro, focusing in on this fourth wave here, which was making a triangle. That also, in the A wave of the triangle, entered the fourth wave, the previous fourth wave of one lesser degree. Channeling. A parallel trend channel typically marks the upper and lower boundaries of impulse waves and zigzag corrective waves. Here is a diagram that illustrates the guideline of channeling. We must know at least 3 points in order to use this guideline. So on the chart on the left, where we see termination points for waves 1, 2, and 3, we can estimate the termination point of wave 4 by first connecting the termination points of waves 1 and 3 and drawing a line, and then drawing another line that is parallel to that line that includes the termination point of wave 2. That helps us to estimate the termination point of wave 4. If we know waves 1, 2, 3, and 4, we can estimate the termination point of wave 5 by first drawing a line that includes the termination points of waves 2 and 4, and then drawing a parallel line that includes the termination point of wave 3 to estimate the termination point of wave 5. If wave 3 is very steep, almost at a 90-degree angle, it is better to draw a line that includes the termination point of wave 1 that is parallel to the line that includes termination points of waves 2 and 4. Let's look at an example. This is the Dow Jones Industrial Average monthly data on a log scale from the 1970s, at this point up until the 1990s. And here we show waves 1, 2, 3, and 4. I can connect the termination points of waves 2 and 4 and draw a parallel line to that line that includes the termination point of wave 3, as I've done here. And when I extend those lines, that will give me an estimate for the termination point of wave 5. And you can see that in here, wave 5 has now terminated slightly above the top of the channel line. We call that a throw over. Here's an example in the euro. In this example, we know waves 1, 2, and 3. So we can draw a line that connects the termination points of waves 1 and 3, and then another line parallel to that that includes the termination point of wave 2 in order to estimate the termination point of wave 4. So I draw those in, as you see here, by those blue lines. So we're looking for wave 4 to terminate in this area. And as I draw in the rest of the price action, you see wave 4 came in right at the trend channel, the lower trend line of the trend channel. Wave 5 actually fell a little short of the upper boundary of that trend channel. We're going to talk about throw over a little bit later, but let me just mention that if wave 4 were to have terminated slightly below the lower trend line of the trend channel, then normally wave 5 would terminate slightly above the trend channel. We also can use channeling in zigzag corrections, but we must know 3 points. So if we know the origin of wave A and the termination point of wave A and the termination point of wave B, we can draw a line that connects the origin of wave A with the termination point of wave B, and then we draw a parallel line to that that includes the termination point of wave A, and that helps us to estimate the termination point of wave C. And here's an example in coffee futures. We had looked at this chart before. We know the origin of wave A in this zigzag and the termination point of wave A, and we have the termination point of wave B. So I'm going to draw some lines in connecting the origin of A with the termination point of wave B. Then I draw a parallel line that includes the termination point of wave A and extend those lines to estimate the termination point of wave C. And as you can see, wave C came in a little bit below the lower trend line of the channel, but it also terminated right at the termination point of the previous fourth wave of 1 less a degree. And here is the guideline of throwover that I was referring to. Throwover means that if wave 4 terminates slightly below the trend channel, then you can expect wave 5 to terminate slightly above the trend channel. So in a sense, wave 4 makes a throw under in this diagram, and wave 5 makes a throw over. If we go back to our chart on the Dow Jones Industrial Average, you'll see how wave 5 made a throw over in the trend channel. It terminated slightly above the trend channel. In this case, wave 4 did not make a throw under. Let's talk a little bit about volume. For waves that are less than primary degree, normally the third wave volume will be greater than the fifth wave volume. If volume in the fifth wave is greater or equal to the volume in the third wave, we normally would have a fifth wave extension. For waves that are greater or equal to primary degree, we experience higher volume in fifth waves. All-time high volume normally occurs at terminal points in bull markets. Volume often spikes briefly at the throwover point of a parallel trend channel line or a diagonal triangle resistance line. Volume normally contracts in corrective waves. So let's look at an example of volume in this chart. This is soybean futures daily continuation chart from September 2002 to June 2004. And we have 5 waves up, waves 1, 2, 3, 4, 5, in this impulse wave. And you can see generally in wave 3, volume was greater than it was in wave 5. However, I want to point out a couple of interesting things here. You have to be cautious about volume. you can get spikes in volume and corrective waves as well, especially at the termination points. Notice how in wave 4, if I look at wave A and wave C, you see the spikes in volume that occurred on those down moves. So you have to be a little careful of how you interpret volume. You have to know what wave you're in. You could still get spikes at certain instances, high volume even in corrective waves, although normally volume contracts in corrective waves. Post-triangle thrust measurement. If you recall, we talked about triangles, these structures that are made up of waves A, B, C, D, and E. And this guideline refers to measuring the width of the triangle. As I'm showing here, we extend the AC and BD trend lines, and then we draw a line perpendicular that connects both trend lines at the origin of the A wave. We take that distance and we add that to the termination point of wave E, as shown over here, and that gives us an estimate for the thrust out of the triangle, gives us a price target estimate for the next wave in the pattern of one larger degree. So let's look at an example of that. This is gold futures, June 2004. It's an hourly bar chart. We have waves 1, 2, 3, and 4, where wave 4 is a triangle. It's made up of waves A, B, C, D, and E. And if we measure the width of the triangle at the origin of the A wave by extending these two AC and BD trend lines, we come up with an estimate of about $6.50 for the width of the triangle, which when we subtract from the termination point of wave E, which comes up at about 422, that gives us an estimate of about $415.50 for the price target for wave 5 in this downtrend. And as you can see, gold came in a little bit below 415, slightly below the estimate based on the post-triangle thrust measurement. Let's summarize what we've covered in terms of guidelines. Two motive waves in a 5-wave sequence will tend toward equality. If the second wave is sharp, then the fourth wave is usually sideways, and vice versa. Corrective waves usually end in the span of the previous fourth wave of one lesser degree. Impulse waves tend to be bounded by a channel composed of two parallel lines. A throw-over or throw-under occurs when wave 5 terminates beyond the trend channel. The post-triangle thrust measurement estimates the price target for the next wave in the pattern of one larger degree. And that concludes the section on guidelines. I want to now cover the topic of wave personality. And as you can see in front of you, you have a chart. This is a representation of an impulse wave, a diagram showing 5 waves up. And we could assume that this is the stock market represented by the Dow Jones Industrial Average, let's say over a 5-year period, just as an example. And I want to take you through each wave and explain the emotional backdrop, emotional and economic backdrop behind each of these waves, because the wave structure is a graphic of mass psychology. Therefore, behind these price movements are real emotions and real economic conditions that are reflected in each phase as we move up in this impulse wave. So if I start at the bottom, and let's assume then we've started with a major recession, possibly a depression. So we have very strong negative emotions. People are very pessimistic at the beginning of wave 1. Economically, the fundamentals are very poor. There's a lot of conflict, a lot of friction. But then prices start to rise and people become a little hopeful. There's some optimism and people feel that, okay, maybe we've now seen the worst and that we're now going to progress forward. Times are going to get better. Then you get wave 2, a setback, and wave 2, as I had mentioned before, is normally quite deep in its retracement of wave 1. And what happens in wave 2 is the pessimism comes back. As a matter of fact, at the low of wave 2, the pessimism is often greater than it was at the beginning of wave 1. And the best way to describe that, the personality of wave 2 is, well, here we go again. We're going back to the times where things were very negative. When wave 2 ends and wave 3 starts to move upward, you then get a turnaround in sentiment. Now people become much more optimistic. And in the middle of wave 3, you have a lot of optimism. You have the economic fundamentals improving. You have some of the best economic fundamentals in terms of low unemployment, the inflation rate, and so on. And this also becomes a catalyst for growth and development in many areas of our culture. So when wave 3 ends and you have wave 4, it's what we call a surprising disappointment. Suddenly we have this mild setback, not as deep as wave 2, and there's a bit of disappointment because the advance did not continue. And finally, in wave 5, optimism returns, and you have a high participation in the stock market until we reach the end of wave 5, although the fundamentals in wave 5 are not usually as good as they were in wave 3. After 5 waves are completed and we start the A wave, at this point, since we've now experienced a 5-wave impulse wave to the upside, people tend to be somewhat complacent and arrogant. There is a general good feeling, so when the A wave begins, in a sense, nobody really takes it too seriously. They think it's just another mild correction like wave 4 that will end soon and that the uptrend will continue again. And so when the B wave moves up, and we normally classify or characterize the B wave as kind of a sucker wave or fool's wave, the B wave lulls people into thinking that that uptrend now has indeed resumed, as shown by the dotted line. The dotted line is what people think is going to happen. But what happens is the B wave will end, and suddenly you get an abrupt turnaround in the C wave. And the C wave, the best way to describe that is just devastating. That all the hope that people had in wave B that the uptrend was going to resume, it is now turned around. And in the C wave, the fundamentals start to really break down. The economic fundamentals are poor, and you have this devastating setback in correcting those first 5 waves up. So that briefly summarizes the different wave personalities. This section is on Fibonacci relationships in financial markets. The Fibonacci ratio is 0.618 and its inverse is 1.618. It is also known as the golden ratio and is often represented by the Greek letter phi. It's an irrational number, and we see this ratio in nature, human biology, and even human thought, as well as in financial markets. We can arrive at this ratio by looking at a series of numbers. If we count just starting from the number 1 and count consecutively, when we add each number to the next, we come up with a series, as you see above, numbers 1, 2, 3, 5, 8, 13, 21, 34, and so on. We refer to these numbers as Fibonacci numbers. When we take each number and divide it by the next number, the number that it's adjacent to, we get a ratio. And as we go forward in this series, that ratio approaches 0.618. The inverse of that ratio is 1.618. In financial markets, we also see the ratio 0.382, which is 1 minus 0.618, 1.0, and 0.5, which is one of the first ratios that we arrive at in the series at the top. And in terms of the inverse, we'll also see multiples such as 2.618 in addition to 1.618. As a matter of fact, we could take any two numbers randomly, such as the numbers 17 and 352, add them together, and go through the same series, adding one number to the next, and dividing each number by the next number, and that ratio would also approach 0.618. In financial markets, we see Fibonacci relationships with respect to both time and amplitude. With respect to price amplitude, there are two types of relationships we're going to look at: retracements and multiples. These diagrams represent Fibonacci relationships with respect to retracements. If we look on the left side, we see a diagram of a wave 1 followed by a wave 2 down. And as you can see on the diagram, wave 2 retraces 0.618 of wave 1, a common relationship. On the right side, we see a common relationship where wave 4 retraces 0.382 of wave 3, or 38.2% of wave 3. So let's look at a real-life example. This is the S&P 500 stock index. It's the cash index daily bar chart from August 2004 up through May 2005. We had looked at this chart before. And let's see what Fibonacci relationships we can find here. First, I've numbered the wave structure, waves 1, 2, 3, 4, and 5. And now, looking just at the first wave up, we see that in this case, wave 2 came close to retracing 0.618 of wave 1. The 618 came in at 1087.86, and wave 2 finished slightly above that. You may also see sometimes that wave 2 will retrace 50% of wave 1. Now let's look at the retracement that wave 4 makes of wave 3. Wave 4 retraces wave 3 slightly beyond the 0.382 retracement at 1168. We also see multiples in impulse waves related to the Fibonacci ratio of 0.618. On the left side of this diagram, you see one common relationship, which is that the price distance of wave 5 is often equal to 0.618, the net distance traveled of waves 1 through 3. In other words, if we take the net distance traveled of waves 1 through 3, multiply that times 0.618, add that distance to the termination point of wave 4, we get a target, a price target, for the termination point of wave 5. Another relationship on the right side of this diagram is that if we look at the net distance traveled of waves 1 through 3, multiply that times 0.382, and add that to the termination point of wave 4, we get a price estimate or price target for the termination point of wave 5. Subdivisions of impulse waves may also be related by Fibonacci ratios 1.618 and 2.618, especially if there is an extension in one of the waves. Here's an example of a Fibonacci relationship in terms of multiples, this is a chart of the Dow Jones Industrial Average monthly bar chart on a log scale from 1932 up until the early 2000s. And as you can see on this chart, wave 5, cycle wave 5, as I'm highlighting here, is related by the net distance traveled of waves 1 through 3 that ended in 1966 by 0.625, or close to a Fibonacci ratio of 0.618. This is the same chart, and so what we're saying is, in other words, it's a ratio of 5 to 8, the distance traveled from the termination point of wave 4 to the termination of wave 5 relative to the net distance traveled of waves 1 through 3. Here's an example in the Dow Jones Utilities Average. And in this case, this chart from the early 1940s up until 2000, if we look at the net distance traveled of waves 1 through 3, multiply that times 0.382, we get the same percent movement for wave 5. In other words, wave 5 on this chart, which is on a log scale, is 0.382, the net distance traveled of waves 1 through 3. We also see these Fibonacci relationships in corrective wave structures. This is the gold-silver index weekly chart from July 2000 up to July 2002. And this is a double zigzag, or what we had called a combination. We have an ABC, and then we have an X wave that links it to another ABC zigzag. And the second ABC zigzag is equal to 1.618, the total distance of the first ABC zigzag. We often see the subdivisions of corrective waves related by Fibonacci ratios of 0.618, 1.0, and also 1 minus 0.618 or 0.382. Let's talk now a little bit about Fibonacci time relationships. You remember those Fibonacci numbers that we had in that series of 2, 3, 5, 8, 13, 21, and 34, and so on. Here's an example. This is the Dow Jones Industrial Average from 1932 up until 2000. And we see an example where wave 3, the end of wave 3, cycle wave 3 in the middle, serves as a divider that divides up the total time in terms of waves 1 through 5 into two segments, each one equal to a Fibonacci 34 years. The total time for waves 1 through 3 is 34 years, and then from the termination point of wave 3 to the termination point of wave 5 is also 34 years. Here's another example of Fibonacci numbers in terms of time. This is the Dow Jones Industrial Average from 1974 to 2000. And again, wave 3 has served as a Fibonacci divider, dividing up first 13 years for waves 1 through 3, and another 13 years from the end of wave 3, that's primary wave 3, up until the year 2000. The end of wave 5. Let's summarize what we've covered in terms of Fibonacci relationships in financial markets. The Fibonacci ratio, an irrational number approximating 0.618, is also known as the golden ratio and is found in nature, human biology, and human thought, as well as aggregate human behavior, such as the stock market. The wave principle is a robust fractal governed by Fibonacci mathematics. Sharp wave corrections, such as in wave 2, tend to retrace 61.8% or 50% of the previous wave. Sideways corrections tend to retrace 38.2% of the previous wave. Subdivisions of impulse waves tend to be related by Fibonacci numbers 0.618, 1.0, 1.618, and 2.618. Subdivisions of corrective waves tend to be related by Fibonacci numbers 0.382, 0.618, 1.0, and 1.618. And that concludes the section on Fibonacci relationships in financial markets. Let's review all of the key points that we covered during the course. This is the basic pattern of the wave principle. We have 5 waves up numbered 1 through 5. Waves 1, 3, and 5 are actionary waves. They're moving in the direction of the main trend of the larger pattern. Waves 2 and 4 interrupt the main trend. We showed how the basic structure of the wave principle, 5 waves up and 3 waves down, is similar at all degrees of observation. In other words, it's a robust fractal, which means it's similar but not exact. The first phase, or 5 waves up, is called the motive phase. The correction that occurs after a 5-wave sequence has completed is called the corrective phase. The motive phase can be divided up into impulse waves and diagonal triangles. The corrective phase consists of corrective structures such as zigzags, flats, triangles, and combinations. Each wave can further subdivide into other waves. There are 3 rules that we follow. First, wave 2 can never retrace more than 100% of wave 1. Wave 3 can never be the shortest of waves 1, 3, and 5, and wave 4 cannot enter the price territory of wave 1 for impulse waves. We talked about various guidelines. Equality. Out of waves 1, 3, and 5, 2 of the motive waves tend toward equality. With alternation, if wave 2 is sharp, then wave 4 is sideways, and vice versa for impulse waves. For corrective waves, the guideline of alternation states that if wave A is a sharp zigzag, wave B will be a sideways or flat correction, and vice versa. In a 5-wave impulse wave, wave 4 tends to terminate in the area of the previous 4th wave of 1 lesser degree. Impulse waves are normally bounded by a channel. We can construct the channel by connecting the termination points of waves 1 and 3 and the termination points of waves 2 and 4. If wave 5 terminates above the upper trend line of the channel, we call that a throw-over. If wave 4 terminates below the lower trend line of the channel, one can expect wave 5 to be a throw-over and terminate above the upper trend line of the channel. Volume tends to be greater in 3rd waves versus 5th waves. If volume in the 5th wave is greater than the 3rd wave, the 5th wave will most likely be extended. We also can see spikes in volume at the termination points of some corrective waves. But normally volume contracts in corrective waves. We calculate the post-triangle thrust measurement by measuring the width of the triangle at the origin of the A wave by drawing a perpendicular line that connects the AC trend line and the BD trend line. And we can use that to estimate the termination point of wave 5. Each wave has its own personality and reflects the emotional and economic state at a given point in time. We see Fibonacci relationships in financial markets, the Fibonacci ratio of 0.618 and its inverse of 1.618, also represented by the Greek letter phi. We see this with retracements where wave 4 will retrace 0.382 of wave 3. We see it in multiples, where wave 5 will be equal to 0.618, the net distance traveled of waves 1 through 3. And that concludes our course on the basics of the wave principle. Thanks very much for watching this course, and I hope you enjoyed it.